Imagine waking up on June 17th to see your portfolio suddenly in the green, thanks to a handful of stocks that just took off. That's the promise being floated by some bold market watchers, including the ever-controversial Shaw Galani, who claims to know which companies will ride the next wave of the Trump trade war. But do these picks really have what it takes? Or is it all just clever marketing? Today, we'll break down the clues, reveal the stocks, and most importantly, separate the hype from the hard facts. Everyone loves a good stock tip, especially when it's wrapped in mystery and promises of untold riches. But with so much noise out there, how do you know which companies are truly positioned for explosive growth? Let's dig into the first story, a tale of rare earths, geopolitics, and a company at the center of America's high-tech ambitions. For years, the United States has relied almost entirely on China for rare earth metals, those crucial ingredients in everything from electric vehicles to advanced defense systems. But as global tensions rise and supply chains get tangled, the U.S. is scrambling to build its own rare earth industry. Enter MP Materials, a company that's not just mining rare earths, but aiming to control the entire process from the ground to the finished magnet. MP Materials recently opened a cutting-edge facility for rare earth alloy and magnet manufacturing right here in the U.S., and they're already locking in major deals, including a strategic partnership with General Motors to supply materials for electric vehicle motors. With backing from the Department of Defense and a $35 million contract to boost domestic processing, MP Materials is positioned as a linchpin in America's push for supply chain independence. So, is MP Materials, ticker MP, the slam dunk buy some claim? Here's what you need to know. MP is the only U.S. company handling the entire rare earth supply chain, from mining to finished magnets. That kind of vertical integration is rare and valuable, as the U.S. tries to reduce reliance on China. With China restricting exports, domestic producers like MP stand to benefit from increased demand and government support. Deals with GM and others provide revenue stability and industry credibility. Revenue is up 25% year over year, but the company is still posting net losses, $22.65 million last quarter, so profitability remains a challenge. The consensus is moderate buy, with a 12-month price target around $23.61. There's upside potential, but also real risks. MP Materials deserves a spot on your watch list, but it's not a sure thing just yet. If rare earths are the future, steel is the backbone of America's industrial present. And behind every steel beam is a mountain of coal, specifically metallurgical coal, the kind you can't make steel without. With infrastructure spending on the rise and global supply chains shifting, could coal be making a comeback? The next company in Shaw's crosshairs is Peabody Energy, ticker BTU, a name synonymous with coal for over a century. While coal has been battered by environmental concerns and shifting energy policies, Peabody is betting big on a different kind of coal, metallurgical or met coal, used in steelmaking. Peabody operates 17 production facilities across the U.S., from Wyoming to Alabama, and produced 115 million tons last year. The company is pivoting hard toward met coal, aiming to triple output by 2026, thanks in part to a $3.8 billion acquisition from Anglo American. With Asia's demand for steel surging, Peabody sees a new growth story unfolding. Is Peabody Energy a relic of the past, or a turnaround story in the making? Here's the breakdown. By focusing on met coal, Peabody is tapping into a market less vulnerable to the price swings plaguing thermal coal. Prices for thermal coal, used in power plants, are at 4-year lows due to oversupply, especially from China. This still drags on Peabody's overall revenue. Despite challenges, Peabody posted $937 million in revenue and $34.4 million in net income last quarter, showing it can weather market storms. Forecasts suggest BTU could more than double in price by July 2025, with a consensus strong buy rating. Peabody is investing in cleaner technologies, including a 5-megawatt power plant using waste gas, signaling a shift toward environmental responsibility. In short, Peabody Energy is a high-risk, high-reward play for those who believe in a steel-fueled industrial revival. We've covered minerals and metals, but what about the tech sector's most hyped corner, artificial intelligence? Shaw's final pick isn't a resource company at all, but a software firm claiming to revolutionize business with agentic AI. The catch? Not all that glitters in AI is gold. UiPath, ticker PATH, is a leader in robotic process automation, helping businesses streamline workflows, process documents, and optimize operations using AI. With a client list that reads like a who's who of the Fortune 500, Amazon, Microsoft, Google, Wells Fargo, Oracle, Salesforce, Adobe, IBM, you'd think UiPath would be riding high. The company touts its agentic AI as the brains behind everything from autonomous vehicles to drug discovery. Financially, UiPath is sitting on $1.66 billion in cash and minimal debt. Earnings jumped 52% year over year. But the story isn't all smooth sailing. Why isn't UiPath a slam dunk buy? Here's what the numbers and trends reveal. Revenue growth is slowing, just 5% year over year in Q4 2025, down from double digits earlier in the year. That's a red flag for a supposed high-growth tech stock. UiPath's reliance on government contracts has backfired, with budget cuts leading to missed deals and a 15% drop in the stock after the news broke. Despite some positive quarters, UiPath posted a $163 million operating loss for the full fiscal year, raising questions about when or if it will turn the corner. Giants like Microsoft are muscling in with their own automation tools, making it harder for UiPath to stand out. Shares are down nearly 60% over the past year, underperforming the broader tech sector and shaking investor confidence. UiPath is a cautionary tale of AI hype outpacing reality. Until growth reaccelerates and profitability improves, this stock is best left on the sidelines. So, what's the takeaway from these three market stories? Each company sits at the crossroads of major economic trends: reshoring supply chains, rebuilding infrastructure, and automating the future. But the path to investment success is never as simple as following the latest newsletter pitch. MP Materials offers a compelling narrative around U.S. self-sufficiency and advanced manufacturing, but it's not yet a profit machine. Peabody Energy is reinventing itself for a new era of steel and sustainability, but the risks of commodity cycles and regulatory shifts remain. UiPath has the right buzzwords and big-name clients, but its financials and growth trajectory tell a more sobering story. The real winners in the stock market aren't just those who chase the hottest tips. They're the ones who dig deeper, question the sales pitch, and understand both the promise and the pitfalls. As June 17th approaches, keep your eyes open, your mind sharp, and your expectations grounded. The next big winner might be out there, but so are plenty of false starts.